Hey everyone, welcome back. Ready to dive deep again?
Always.
Awesome. Today we're jumping into Warren Buffett's world, specifically his 1983 letter to Berkshire Hathaway shareholders.
Oh, that's a good one. A real classic.
It is, and we've got some interesting questions alongside it to guide our discussion. It's like we're time travelers getting to peek into Buffett's mind. Even back then, he was already so successful, but you can see how his thinking was evolving.
Exactly. It's fascinating to see what he was focusing on, what he was prioritizing, even after he'd already made a name for himself.
Right. And it gives us some clues about what he might be looking for in companies even today.
Absolutely. Those core principles, a lot of them are timeless.
So let's jump in. One of the first things that struck me in this letter is how Buffett emphasizes partnership. He talks about himself and Charlie Munger as managing partners and the shareholders as owner partners. Why do you think he frames it that way?
Well, it's not just talk. This we're all in this together approach is fundamental to how Berkshire operates.
It's more than just a philosophy, right?
Yeah, I mean, Buffett even points out that in 1983, most of the directors had a huge chunk of their own family's net worth tied up in Berkshire stock. They weren't just calling shots from a distance. They were deeply invested alongside everyone else.
That's a powerful statement. And it ties into another big idea, intrinsic value. Buffett really hammers home that Berkshire's goal is to maximize the average annual rate of gain in intrinsic business value per share.
Right.
Now, I think a lot of people hear intrinsic value and their eyes kind of glaze over. Sounds very Wall Streety.
It can, yeah.
So what does it actually mean?
It's a great question, and it's really at the heart of Buffett's approach. Intrinsic value goes beyond just the numbers you see on a balance sheet. It's about understanding the true worth of a company based on its ability to generate earnings, not just today, but into the future.
It's about potential, isn't it?
Exactly. Think of it like this. Two kids go to college. Both educations might cost the same, that's like book value, but their future earning potential could be wildly different. That's their intrinsic value.
I like that analogy. So you could have two companies with similar financials on paper, but one might have a much brighter future because of its growth prospects or some other competitive advantage.
Exactly. And this was a big shift for Buffett, too. Early in his career, he was taught to prioritize tangible assets, factories, inventory, things you can see and touch. But he came to realize that businesses with strong economic goodwill often outperform those with lots of physical assets.
Okay, so how does economic goodwill translate into real-world success? Can you give us a concrete example?
Absolutely. One of the best examples is See's Candies. Buffett bought See's in 1972 for $25 million, which was a lot more than its net tangible assets. People thought he overpaid.
But I'm guessing he saw something that others missed.
He did. He saw the power of See's brand, their loyal customers, their ability to raise prices without scaring people away.
Their pricing power.
Yes. These are all elements of economic goodwill. See's had a reputation for quality that allowed them to charge a premium for their products.
So Buffett was willing to pay extra for that brand loyalty and pricing power because he saw it as a long-term advantage.
Exactly. And the results speak for themselves. See's has been a cash cow for Berkshire, consistently generating high earnings and growing its intrinsic value.
It's a great story. It really shows how Buffett thinks differently about value. Now, there's another part of the letter that really surprised me. Buffett challenges this idea that inflation is always good for tangible assets. He actually says that inflation hurts asset-heavy businesses more than those with strong intangible assets.
Yeah, it seems counterintuitive, right? You'd think real estate or gold would be safer during inflation.
Exactly. So how does he justify this view?
He uses See's Candies again to make his point. Let's imagine another business. We'll call it a mundane business. Lots of tangible assets, but not a lot of earnings power.
Okay, I'm picturing like a factory making, I don't know, widgets.
Perfect. So during inflation, both See's and this widget factory need to increase their earnings just to keep up with rising costs. But the widget factory has to invest heavily in more equipment, more raw materials, just to produce those higher earnings. See's, on the other hand, can generate those higher earnings with a lot less additional investment because their value comes from their brand and customer relationships, not from a bunch of physical stuff.
So inflation widens the gap between those two businesses. The asset-heavy one is constantly playing catch-up, while See's can keep churning out profits.
Exactly. And that's a key insight that a lot of people miss. It really highlights the importance of focusing on businesses with strong economic goodwill, especially during inflationary periods.
It's one of those aha moments that makes you rethink your assumptions.
Oh.
Okay, another topic that grabbed my attention was Buffett's stance on stock splits. He seems pretty strongly against them.
He is.
Why should we care about stock splits? What's the big deal?
Well, it all goes back to Buffett's focus on attracting the right kind of shareholders. He wants long-term, business-minded investors who are focused on intrinsic value, not people just chasing quick profits.
So he's being very intentional about who he wants to own Berkshire Hathaway stock.
Absolutely. And he believes stock splits, by making the share price seem lower, tend to attract a different kind of investor, one who's more interested in short-term price movements rather than the long-term health of the business.
So it's not just about picking the right companies, it's also about cultivating the right shareholder base.
Exactly. And Buffett even points out this fascinating irony. The stock market's obsession with activity with high share turnover actually acts as a hidden tax on investors.
How so?
Well, every time shares change hands, there are transaction costs, right? Brokerage fees, taxes, all that. Those costs can really eat into your returns, especially if you're constantly buying and selling.
It's like death by a thousand cuts.
Right. And he contrasts this with Berkshire's low turnover. Because most Berkshire shareholders are in it for the long haul, they avoid all those frictional costs and benefit from the power of compounding over time.
It's all about patience and playing the long game. Now, speaking of the long game, Buffett lays out his specific criteria for acquisitions in this letter. It's like a wish list for companies he'd love to bring into the Berkshire Hathaway family. What are some of the things he's looking for?
He lists 6 key criteria: large purchases, a demonstrated consistent earning power, good returns on equity with little or no debt, management already in place, simple businesses, and a clear offering price.
Wow, that's quite a list.
It is. And each of these criteria reflects his overall investment philosophy. For example, his preference for simple businesses ties into his belief that he needs to understand the companies he owns. He's not going to invest in something he doesn't get. And his emphasis on consistent earning power shows that he's not a gambler. He wants businesses with a proven track record of success.
It's like he's looking for businesses that are both excellent and predictable.
Yeah.
No big surprises.
That's a great way to put it. He wants to be confident that the businesses he buys will continue to perform well for years to come.
And it makes you wonder, which companies today would fit Buffett's 1983 wish list?
That's a great question to think about.
Definitely something to ponder. Okay, so we've talked about some of Buffett's big picture ideas, but this letter is great because it also gives us a peek into the actual businesses Berkshire owned back in '83. He starts with the Buffalo Evening News, a local newspaper. What was going on with that business at the time?
Well, the news was facing some headwinds. Buffalo's economy wasn't exactly booming, and that meant less money for businesses to spend on advertising.
Right, that makes sense. A tough economy is usually bad news for local newspapers. But Buffett mentions a high penetration ratio as a positive sign. Can you explain that? The penetration ratio, it's not exactly everyday language.
It sounds technical, but it's actually pretty simple. The penetration ratio just means what percentage of households in a given area subscribe to a particular newspaper. And even though Buffalo wasn't a huge city, the Evening News had a remarkably high penetration ratio.
So people in Buffalo really loved their local paper, even with the economic challenges. What do you think contributed to that loyalty?
Buffett points to a few things. First, Buffalo's population was relatively stable, so you didn't have a lot of people moving in and out. Second, the news had a strong reputation for quality and integrity. People trusted it. And third, it was committed to delivering a lot of actual news content.
He even talks about the news hole, which I've always found to be an interesting term. What exactly does that refer to?
The news hole is a proportion of the newspaper dedicated to actual news stories, articles, editorials, basically the stuff people read for information as opposed to advertising. Some newspaper publishers were cutting back on their news holes to save money, but Buffett saw that as a mistake. He believed that a news-rich paper was more valuable to readers and ultimately to advertisers in the long run.
So even though it might have squeezed profits in the short term, he was willing to invest in quality content to build a loyal readership. It's a long-term perspective, right?
Exactly. It's about building a sustainable business, not just chasing quick wins.
Now, despite this strong local presence, the Buffalo News was facing a challenge that was hitting newspapers across the country.
Yeah.
The rise of pre-printed inserts. You know, those flyers and coupons that always seem to fall out when you open the paper?
I know, yeah, those things. And preprints were a problem for newspapers because they generally had lower profit margins than traditional print ads. Plus, there was more competition in the preprinting business.
It's interesting, isn't it? Even a great business like the Buffalo News wasn't immune to these broader industry shifts.
That's right. It shows how important it is to always be adapting and evolving as a business. The competitive landscape is always changing.
Okay, let's shift gears and talk about See's Candies. We've already touched on this business, but it's worth another look. What additional insights does Buffett provide about See's in this letter?
Well, he includes a table showing C's revenue and profits over time, and it's remarkable how consistent they were. But he also points out two key problems: rising costs and a plateau in sales volume.
Uh-oh. Rising costs are never a good sign. What was driving that trend?
Buffett mentions that costs, excluding raw materials, were rising faster than inflation. That was a concern, but he also expressed a lot of confidence in Chuck Huggins, the guy running C's. He believed Huggins could get those costs under control.
I'm with you, right?
He was. Huggins was a really talented operator, very skilled at managing costs effectively.
So they had a handle on the cost side eventually. But what about the stagnant sales? It seems like even with a great brand and delicious products, growth wasn't guaranteed.
Yeah, that was a puzzle. Buffett admits that she wasn't entirely sure what was behind the flat sales. He speculates that it could be C's pricing strategy, broader trends in the candy industry, or maybe just the fact that they already had such a dominant market share in their region.
It's interesting to hear him acknowledge that he didn't have all the answers.
I think that's one of the things that makes him so credible, honestly. He's willing to admit when he's not sure about something. Too many leaders try to pretend they have it all figured out.
That's a good point. Now, despite these challenges, Buffett clearly saw a lot of potential in C's. What strengths did he emphasize?
Well, he reiterated some things we've already talked about: the dominant market position, the reputation for quality, but he also highlighted their exceptional customer service, particularly in their company-operated stores.
He seemed really impressed by that.
He was. And it makes sense when you think about it. Customer service can be a huge differentiator, especially in a business like C's.
Right, it's not just about the product, it's about the whole experience.
Exactly. Okay, after discussing C's, Buffett moves on to the insurance industry, which, as you know, was a major part of Berkshire's portfolio. And here's where we see a bit of humility from the Oracle of Omaha himself.
Oh, really? Does he confess to making some bad bets?
He does. He says that the insurance businesses he was directly responsible for had absolutely terrible results in 1983. And he takes full responsibility, admitting that those poor results stem from decisions he had made a few years earlier.
I love that he's so transparent about his mistakes.
It's refreshing, isn't it? It's a good reminder that even the best investors make mistakes.
Now, what about Geico? That was another big insurance holding for Berkshire.
Yes, but Buffett didn't directly manage Geico at the time, and their results were a completely different story. They had a fantastic year. Their combined ratio, which is a key metric in the insurance industry, was 96 compared to the industry average of 111.
That's a huge difference. What was driving Geico's success?
Buffett credits their strong performance to what he calls their truly exceptional business idea and their exceptional management, led by Jack Byrne, Bill Snyder, and Lou Simpson. He clearly had a lot of respect for that team.
So it reinforces this idea that great businesses need great managers.
Absolutely. It's a theme we see again and again in Buffett's writing and his investments.
Now, despite Geico's great year, Buffett doesn't let himself off the hook for the struggles of his other insurance businesses.
Right. He makes it clear that there's still a lot of work to do to turn those businesses around. And he hints at a potential new area of focus: reinsurance and structured settlements.
Can you explain what those are? I'm not super familiar with those terms.
Sure. Reinsurance is basically insurance for insurance companies. They transfer some of their risk to another insurer. And structured settlements are a way to settle insurance claims by making periodic payments over time, often for a person's lifetime, rather than paying a lump sum all at once.
Okay, so why would Berkshire be interested in these niche areas of insurance?
Well, they require a very high level of financial strength and a long-term perspective, two things that Berkshire had in abundance. Buffett saw them as opportunities for growth, particularly because they could generate a lot of investment income relative to the amount of premium volume they wrote.
I see. So it was about finding pockets of opportunity that aligned with Berkshire's strengths. Now, the final part of the letter, Buffett touches on a few other topics. He reiterates his criteria for acquisitions, which we discussed earlier.
Yeah, he actually repeats the exact same list from the previous year. He was definitely serious about those criteria.
He was clearly looking for the right businesses to add to the Berkshire family. And he emphasizes that he's looking for good homes for businesses and their managers, not just quick flips for a profit.
Right, it's not just about the numbers for him, it's about finding businesses and people he can trust and build long-term relationships with.
That's a great point. He also talks about Berkshire's Shareholder Designated Contributions Program, which allows shareholders to direct a portion of the company's charitable giving to causes they care about.
It's a really unique program. You don't see that very often. It's another example of how Buffett treats his shareholders like partners, giving them a say in how the company operates.
He even encourages shareholders to make sure their shares are registered in their own names rather than held in a brokerage account so they can participate directly in this program.
He really wanted to have a direct connection with his shareholders and cut out any unnecessary middlemen.
He also briefly mentions the merger with Blue Chip Stamps, a company Berkshire had acquired. He says the merger went smoothly and was already creating tax benefits. And finally, he wraps up by highlighting the minimal dilution that Berkshire's original shareholders have experienced since he took over.
Meaning their ownership stake hasn't been significantly reduced, even though the company has grown tremendously over the years.
Right. It's a testament to his focus on creating value for his long-term shareholders. So we've covered a lot of ground in this letter, but there's one more crucial section we need to unpack: the appendix on goodwill and its amortization. This is where things get a bit more technical, but stick with us, folks. It's really important for understanding how Buffett thinks about value beyond just the basic numbers.
I agree. It's one of the most insightful parts of the letter, but it does require a little extra brain power.
Are you ready to dive in?
Let's do it.
All right, folks, buckle up. We're about to get into the nitty-gritty of accounting.
The glamorous world of goodwill and amortization.
You make it sound so exciting. But in all seriousness, this appendix on goodwill is where Buffett really unpacks some key ideas about how he thinks about value. And I think it can be a bit confusing if you're not an accountant.
It can be, yeah.
So let's try to make it as clear as possible. First things first, what exactly is goodwill?
Good question. It's kind of a weird concept. Think of it like this. You decide to buy a local bakery that's super popular. You're paying for all the tangible stuff, the ovens, the ingredients, the building itself, but you're also paying for something else, something harder to measure.
Like their secret recipe.
Exactly. Or their reputation in the community, the loyal customers who line up every morning for their donuts, the friendly atmosphere. All those things contribute to the bakery's success, but they're not physical assets.
Yeah.
That's what we call economic goodwill.
Okay, so economic goodwill is like the intangible it factor that makes a business special and allows it to charge a premium for its products.
Precisely. It's the value that comes from things like brand recognition, customer loyalty, a strong management team.
Okay, I'm starting to get it. So how does this relate to accounting goodwill? Is that the same thing?
It's related, but not exactly the same. Accounting goodwill comes into play when one company buys another company. Let's say a big food conglomerate decides to buy that bakery we were talking about. They'll pay a price that includes the value of all the physical assets, but they'll probably also pay a premium on top of that.
Because they're recognizing the value of that secret recipe and the loyal customer base.
Right, and that premium, that extra amount they're willing to pay, is recorded on the balance sheet as accounting goodwill.
So it's like saying, hey, we know this bakery is worth more than the sum of its parts, so we're willing to pay a little extra for that intangible value.
Exactly. But here's where the accounting rules get a bit tricky. They require this accounting goodwill to be amortized over a period of time.
Amortized, what does that mean?
It means it's gradually reduced as an expense on the income statement each year, typically over 40 years. So even though you paid a lump sum for that goodwill up front, the accounting treatment makes it look like it's slowly disappearing over time.
Even if, in reality, the bakery's brand and customer relationships are still strong, maybe even getting stronger.
That's the problem. And that's why Buffett argues that this accounting treatment can be misleading. It doesn't always reflect the true economic reality of the business.
It can make a healthy business look less profitable than it actually is.
Right. And Buffett gives a great example of this using, you guessed it, See's candies. Remember, he paid a premium for See's, which created a chunk of accounting goodwill. But he says that See's economic goodwill, its true earning power, was actually increasing over time and not decreasing.
Because people kept coming back for more of those delicious chocolates.
Exactly. Their brand loyalty was strong, and they were able to consistently earn higher returns on their investments. So the accounting rules, by amortizing that goodwill, were understating the true value of See's.
It's like they were focusing on the rearview mirror instead of the road ahead.
That's a great way to put it. Now, Buffett also makes this fascinating point about how economic goodwill tends to behave during periods of inflation.
Most people assume that inflation is bad for all assets. How does he challenge that assumption?
Well, he argues that inflation can actually benefit businesses with strong economic goodwill. Let's think about that bakery again. When inflation hits, the cost of everything goes up: flour, sugar, wages. So the bakery has to raise prices.
To stay profitable.
Right. But because it has such a strong brand and loyal customers, it's more likely to be able to raise those prices without losing too much business.
People are willing to pay a bit more because they love that bakery.
Exactly. Now compare that to a business with lots of physical assets but weak economic goodwill. Let's say it's a factory making generic widgets. They also have to raise prices to keep up with inflation, but they might face more pushback from customers because their products aren't as unique or desirable.
And they probably have higher costs because they have to invest in more equipment and inventory to keep up with demand.
Precisely. So inflation actually widens the gap between those two businesses. The bakery, with its strong economic goodwill, can adapt and thrive. The widget factory, with its heavy reliance on tangible assets, struggles to keep pace.
It really highlights the importance of intangible assets, especially during times of economic uncertainty.
It's a key takeaway for investors and business owners alike. Now, a quick word of caution. Buffett also warns against what he calls spurious accounting goodwill.
Spurious. What does that mean?
It's the kind of goodwill that's created when managers overpay for acquisitions. Maybe they get caught up in the excitement of a deal, or they're trying to build an empire, but they end up paying way more than the acquired business is actually worth.
So the accounting goodwill on the balance sheet is inflated?
Yeah.
It doesn't reflect any real economic advantage.
Exactly. And Buffett jokes that maybe they should call it no-will because it represents a destruction of value rather than a creation of value.
I love that. Okay, so based on all his insights about goodwill, what advice does Buffett give to investors and business operators?
He offers two main pieces of advice. First, when analyzing a company's operating results, ignore the amortization charges related to goodwill. Focus on what the business can earn on its net tangible assets before taking that amortization into account. That gives you a truer picture of the underlying economics.
It's about looking beyond the accounting and understanding how the business actually makes money.
Right. Second, when evaluating a potential acquisition, he says to also ignore the amortization of purchased goodwill. Think of it as a sunk cost. You paid it, it's done. Focus on whether the acquired business can generate a good return on that investment, regardless of how the accounting might make things look.
It's about focusing on the substance, not the form.
Exactly. And that's really the key takeaway from this whole appendix. Accounting is a useful tool, but it's not the be-all and end-all. Investors and business owners need to look beyond the numbers and understand the true drivers of value.
And that's what we've tried to do in this deep dive into Warren Buffett's 1983 letter. We've explored his views on partnership, intrinsic value, economic goodwill, and so much more.
It's amazing how relevant his insights remain, even decades later.
If you're interested in learning more about Buffett's investment philosophy, I highly encourage you to check out the full 1983 letter. It's packed with wisdom.
And as you read it, think about these questions. Would you have bought Berkshire Hathaway stock in 1983, knowing what you know now? And what might this letter tell us about how Buffett might be approaching investment decisions today?
Those are great questions to ponder. Until next time, keep diving deep.